All right. Well, it looks like uh, people logging in, it's starting to slow down now. So we are going to go ahead and kick things off this afternoon. I want to thank everybody for taking the time to join the call. I'm excited to be here for our 27T charted series and discuss a manual for navigating market volatility. And I'm really excited about this. I really enjoy walking through these charts and providing some backstory in terms of what's going on in the markets and trying to arm you with the information that I think is relevant to what's going on and help you better understand how to prepare for uncertainty that will inevitably come up in the markets in the future. This will be an ongoing series with different topics and considerations. It's something where I really like to provide a lot of market data, so sometimes it can get a little nerdy, full disclosure. So we want to talk about a couple of housekeeping items. First, we are recording this call today. So for anybody that is on the call, has to jump off early, or maybe wanted to go back and review information or pass the information along to somebody you care about, this will be distributed following our conversation today. We also have the webinar chat open to everybody. So please, if you have questions as we go through the material, feel free to pop them in the chat. We're also going to utilize time at the end for an open Q&A. But I would like to say that we want to make this interactive. We want this to be beneficial for you. And at the end of the day, we want to arm you with the tools and resources to make the best financial decisions for yourself and feel comfortable and confident in those decisions as you move forward. And, as I was preparing for this presentation, I was thinking, I don't know, market volatility has kind of slowed down here recently. And, coming out of April, we've seen markets really turn around quickly. And we've seen a big bounce back, and then things have kind of quieted down from a volatility perspective. But I think this will be a good opportunity to get some understanding, some data behind what is moving markets, why do markets move, or is this normal, is this not normal? Am I set up appropriately to weather these volatility storms? And really, those are the key concepts that we want to focus on today. So really starting at the top, I like to show volatility in the stock market is normal. It happens every year. It's something where markets go up, they go down. Sometimes they are quieter than other years where they're super loud and super concerning. But what you can see is even through some of the best market return years, you see these negative drawdowns each and every year. Now, this isn't hey, the market is down 12% for the year, but hey, off of the market highs, we're seeing a 10% drop or a 12% drop. And this is in consistent market related action. So it's consistently going from a positive 10 to a negative 2%, something along those lines. The other component that I think is really interesting are highlighting some of these rather negative events as of late. If you look at 2020, we had market volatility in the extremes, and nobody could see COVID coming. Nobody could see the fact that we were going to shut down the economy as a whole, and markets reacted incredibly quick. And we saw a complete drawdown of the market of almost 34%. And I remember trying to guide clients through these uncertain events saying, hey, this sucks. This is really hard to deal with, but you got to hold on. You're going to be better off holding on. Things will get better. We just don't know when. And sure enough, even before the end of the year, in the height of COVID, in the height of uncertainty, markets not only made up for that 34% loss, but they actually returned 16% overall for the year. And I think that's an incredible story about how volatility can be incredibly difficult to navigate, but making sure that your strategy will hold up through those ups and downs are really what's going to be important for you to generate the type of returns that you want to in the market to create value and create money for yourself. I'm a huge believer that a retirement plan, a 401k, is a greatest opportunity for an employee to build wealth for themselves and create that wealth independence for yourself. But you can't do that simply by putting a dollar in every pay period. You need that dollar to be working for you, whether the markets are up or down. And every year there's going to be bouts of volatility, bouts of uncertainty. Just some years are going to be crazier than others. Even this year, 2025, in April, as tariffs were announced and rolled out, markets reacted incredibly fast. I mean, we were seeing some of the largest 5-day drawdowns that we've ever seen in the history of the market. And I saw an interesting stat actually the other day. So as of year to date, markets are up 13%. We saw a drawdown of close to 20% in April. And let's say you, as an investor, freaked out after the announcement and sold following the tariff announcement, where markets ended up going into turmoil. And you stayed out for a day, and then you realized as markets returned, you're like, hey, I think I need to get back in. I think we've got this figured out. And one, most people are not going to do that. But two, for hypothetical perspective, let's say you did. That 13% annual return actually would be 3% missing just that first day bounce. So you're cutting your overall return from 13% all the way down to 3% by just missing one day of a market turnaround. So again, just driving back and trying to drive home the component that asset allocation, portfolio strategy is really what's going to set you up for success over the long run. Bonds are an important component of everybody's portfolio. Whether you're using them or not, it's important to understand the role that they play in portfolio construction. If you're in, let's say, a target date fund, the default investment option in a retirement plan, you're going to have allocation to bonds. If you're using maybe some generic asset allocation to match where you are from an age perspective or goals perspective, if someone's saying I'm in 80-20 or 70-30 or 60-40, that's going to be your difference between your stock allocation and that volatility we talked about earlier and your bond allocation. Bonds are more stable than stocks. As you can see, when you compare this chart to the previous chart, you're not going to have as much volatility in bonds as you are in stocks. And that's why it's an important component to think of these things in totality. I'll start off by saying that bond volatility is a real life phenomenon as well. Using 2022, the bear market example of 2022 as an example, bonds fell considerably in that time period. But what you will notice is bonds didn't fall as far. And so when I'm thinking about portfolio construction and how bonds play a role in your allocation, it's how do you dampen the stock market volatility when things go wild, when things go crazy. And so bonds can generate positive returns, but really they're meant to mitigate that volatility for you. And that's because you're not having as high of highs, not having as low of lows. And it can actually create a smoother ride from an investment perspective than being all in stocks. But at the end of the day, it's important to understand what your goals and objectives are, and then building that into your asset allocation model. So we're looking at from this chart is the number of 1% down days in the stock market year to year. And so what we want to show here is a 1% move, people tend to start picking up. They start thinking about, hey, markets are down, what's going on? Is everything okay? Sometimes that 1% move is, from larger macroeconomic activity. Sometimes it's some unforeseen fear that may not even materialize. So it's important to understand that these are very natural and normal occurrences. They can feel large. A 1% move in a day can certainly be an event that's stomach churning, for some people. And it's important to know that this will happen. It's part of investing. And at the end of the day, these ups and downs in the market are how you earn those long-term stock market returns. It's being able to move through these down days of these big move down days of 1% or more. To date, it's been a crazy year from a market perspective, and we're actually below average from the amount of 1% drawdowns over the last 35 years. And so where things can go, a big part of my market philosophy today is that the stock market's actually moving faster now than ever before. And so where some of these historic events will be important to understand, markets are moving much faster. Your typical correction tends to be a sharper V shape than they have been in the past. The tariff meltdown lasted about a week and a half. And that's an important component from a psychological perspective. One is working professionals. You may not have the ability to go in and trade your account on a daily basis. I would argue that's a good thing. Two, there are bigger ramifications when making short-term moves. You have more potential to negatively impact yourself than positively impact yourself if you are trying to time the market, because it's moving even faster than it was before. So that's where, as the example of this year, if you missed the first day of positive returns coming off of the tariff debacle, as opposed to earning 13% year to date, you're only earning 3% year to date. And I think that's just such an important statistic to understand. If anybody listens to the financial media, maybe watches CNBC to get some understanding of what's going on in the market and the economy, the VIX is often a topic of conversation for news pundits. This is the volatility index. Really what we're looking at is some options as it pertains to the S&P 500. And when uncertainty rises, you tend to see higher volatility in the market. You tend to see the VIX shoot up. And you see these big spikes here, 2008, 2009, 2020, 2022, and then the most recent tariff situation. And, really, I think it's important to understand, if you are paying attention to financial media, what the VIX is, and really just that it's a fear gauge and an expectation of the short-term volatility in the market. This isn't something where we're expecting long-term, let's say 24, 36 months of volatility, but in the near term, what we're expecting is this type of volatility. And really, it's those expectations that actually can drive market returns over time. And we'll talk a little bit about that in the coming slides. And I think really what is shown here is such an important component to why pay attention to the VIX. So what we're showing here is the various levels of the VIX indicator and what the 6-month future returns are. And so what's interesting is if you're very low on the index level, those starting levels, you have very little fear. Returns are pretty good. But as you look towards more fear, so if you look all the way to the far right, and that's saying, hey, the VIX level, the short-term concerns over market volatility are at all-time highs. You look 6 months into the future, markets are up considerably, 12.7%. And this is looking at data all the way back to 1990. So 35 years of stock market data. Why is that? Really the big aspect of why this happens is coming out of extreme uncertainty and fear, you tend to see the biggest gains. The bounces off the bottom of market lows are bigger than any other market return days that you'll see across market history. So whether that's coming off of 2008, 2020, or even this year, you would see the largest return days are those off of the largest down days. And that's simply a function of if you look at why markets move, it's the difference between expectations and reality. The markets are pricing in more data than anybody and one single individual could ever comprehend in a day. And it's trying to make sense of everything that's going on in the world. Well, when things end up being better than expected, you tend to have positive returns. When things end up being worse than expected, you end up having negative returns, just to simplify things here. And so when expectations are at their lowest, the world is going to end. Things are never going to get better. I don't know what I'm doing in the stock market. Why would I ever invest my money in this? All I've done is lost money. Then when it turns out being not as bad as expected, you have a very low bar to hurdle over. When everybody thinks that things are only going to get worse and never get better, and then they're a little bit better than the worst possible outcome, you tend to have a positive surprise and big market jumps, which is why we see this side of the graph be so much higher than this, where there's not very much fear. And it can also be, the VIX can also be an indicator of changing market environment. And so where we see these days where the VIX spikes above 40, you tend to see markets jump up, or right here in the early 2000s, you saw the stock market bubble crash as well as September 11th, followed by some pretty positive returns, followed by our second, kind of hill, if you will, of the dot-com bubble. Same thing with 2008. So there's a huge change in what's going on in the market. There's total uncertainty. Is the financial market going to continue as we know it? We're not sure. You're seeing these huge spikes all the way down, and as markets transition, all the way down, markets transition. And so you can see here as things change in the world, you see the VIX spike, and then you see us move on. So a big aspect, a lot of times people come to me with questions of, do I get out of the market? Is now a good time to sell? Are things at an all-time high? One, I think you should be an investor for life. Two, it's really difficult to catch a falling knife. It's very easy to pull yourself out of the market. It's very difficult to get back in. Today we still don't have answers on, are we going to be okay with tariffs? Are they going to come back on? Are they not? We're really not sure. I don't think that it's going to have a major impact moving forward personally, but they could. And with those expectations not necessarily built in, we could see the market turn around and get hit again if we maybe come back with higher tariffs across the board, right? So those are considerations where we don't know what's going to happen, and things don't necessarily ever get clearer from a market perspective. So you want to make sure that when you're actually making decisions on, am I doing the right thing from an investment standpoint, you're asking yourself two important questions. One, what are my goals? What are my long-term goals? What am I trying to achieve? And two, am I set up to achieve those appropriately through the way I've allocated my investments? And so that's really what you should be focusing on, not what's going on in the market today. Do I sell or do I buy? And I like this chart as well because we're looking at different down days and how frequent these things occur. And really, 5% drawdowns are not unusual. We've seen 71 of them over the last 75 years. That's almost one a year. 10% drawdowns, that's what's called a market correction. You get one of those almost every other year. A bear market, 20% or greater. Again, you're looking at 21 out of the 75 years. So I just like to put this into perspective that, we had a 10% or more drawdown this year. We had a 20% or more drawdown in 2022. If you've been invested, especially for 401k investors, if you've gone through those type of scenarios, that's awesome. You're doing great. And know that more of that is likely to happen in the future. And actually, it could be more painful. It could be longer, it could be deeper, but making sure that, again, you go back and you answer those two questions. What are my goals? And will my allocation allow me to sleep at night as I work to achieve those goals? And just another visual representation here of that 5% pullback, how often they happen, anywhere from 1 to 4 times a year. Typically, you'll have a very normal 5% market pullback. I feel like I've harped on this quite a bit, but I think this visual representation is a fantastic way to look at buy and hold versus trying to time the market. So the yellow line is showing you $1,000 invested in 1990 versus $1,000 invested in 1999 in 1990 in the green, but every 5% pullback, you sell out and buy at the next high. So as the market pulls back, you say, I'm out, and then you wait for the market to correct itself and get back to where it was, and you buy back in. You're looking at a 6x difference between buy and hold and trying to time the market. Now, it's hard to maybe be as poorly timed as that, but I think the representation is important. You're not even missing, trying to miss the 20% down days. This is just a 5% pullback and then waiting for it to return 5%. It's very difficult to make money in the market unless you have dedicated resources to really quantum. We're at the point now where it's almost quantum computing, and making sure that you have all of your resources focused on the daily moves in the market, because really the people that are making moves on a daily basis are those quant type of investors that are trading mathematically and not systematically. And so I think that's an important component to consider when, do I trade or do I not? Be an investor, not a trader. And we talked about this a little earlier on, bonds and how they perform during drawdowns. Again, you can see in the gold line, that's the bond index. The green line is the stock index. And what we're showing you here is stocks are going to be far more volatile. And it's just part of investing. And the bond market can actually be that buffer for you, because oftentimes what you see is bonds will perform better when stocks are having a hard time. So it can offset some of the negative reaction as it pertains to market performance by putting some of your money to work in bonds. Folks that really should spend more time thinking about, hey, should I be invested more in bonds, are those that really struggle to sleep at night when markets are going crazy. If you've lost sleep over whether the stock market is up or down, this can help you with that in mitigating some of the risks, some of the volatility that comes with investing in stocks. Two, if you're getting closer to retirement or have an immediate need for your retirement savings, bonds will help limit any sort of short-term potential volatility and ability to access money in your account. So those are a few things to consider when looking at the volatility of stocks versus bonds and how they can play together in your portfolio. Then diving deeper into asset allocation and again, why it's important. What we're showing you here is we're using that 5% pullback number again as a baseline from a volatility perspective. We're looking at the left side if you're all invested in stocks. All the way to the right side, you're all invested in bonds. And so what do these numbers mean? At 100 to 0, that's 100% in stocks, 0% in bonds. 0 to 100, 0 out of 100, 0 in stocks, 100 in bonds on the right. Then 90-10, that'll be 90% stocks, 10% bonds. 50-50, 50% stocks, 50% bonds. And so what we're showing you here is on the left-hand side, how many 5% pullbacks over the last 35 years since 1990. You're looking at 41 5% pullbacks if you're all in stocks. But as you can see, as you move down the allocation here, you have less pullbacks of 5% or more as you add that bond allocation to your portfolio. So again, if you are somebody that struggles with staying invested, maybe you really have a hard time seeing your account value go down. That would be a good indication of maybe I need to up my bond allocation and limit those times where I'm feeling uncomfortable about investing. You're going to have the highest return potential being in stocks, but you're going to have the highest likelihood of success if you're able to remain invested, whether that's all in stocks or a mix of stocks and bonds. Another chart, this is diving deeper into market pullbacks. Same deal here, all stocks on the left, all bonds on the right. We're looking at 14 pullbacks of 10% or more if you're in all stocks. 50% stocks and bonds, that number drops to half, 10% pullbacks or more over the last 35 years. If you're in all bonds, you've had one, and that was 2022. So just something to consider when we're looking at the different allocations. And really, that's the main topic that we wanted to talk about today, is looking at the various components of market volatility and how it impacts you, your portfolio, how you should be thinking about allocating your stocks and your bonds, and why it's important to consider those. Just as a review, your stocks are going to be the highest growth potential investment that you have in your portfolio, but bonds can be a nice complement for those that have concerns about the market volatility or have large expenses upcoming or immediate needs to those retirement accounts. So I want to thank everybody for joining me for these prepared remarks today. I do want to open it up to questions. If anybody has questions as it pertains to market volatility, what's going on in the stock market today, if there's something we didn't necessarily cover that you were hoping to hear about, I'd like to open it up now to those questions. We've got two options to ask questions to. You have the webinar chat or the Q&A box that you can put those questions into. So right now, I would love for those that do have questions to enter those into the chat or enter them into the Q&A. We'll give people a couple of minutes to get that taken care of. In the meantime, as we look towards the end of the year, I think there's a lot of questions as it pertains to what inflation is going to look like, what the labor market is going to look like. Right now, things look to be decent from an economic perspective. And I think that, as we look towards year end, barring unforeseen circumstances, the market's going to continue moving in a positive direction. There's a changing dynamic to the market overall, where we're seeing a lot of focus on AI-related companies. I think it's an interesting component. I think it certainly helped us in the short term weather some economic uncertainty, given the amount of money that's being poured into research and development and a lot of these AI deals. So one of the most interesting aspects of that I'm keeping an eye on is, for the most part, a lot of the AI spend has been able to be funded by, regular capital investment directly from a company and not financed by debt. Oracle has kind of flipped that narrative with some recent agreements with OpenAI, and it has the potential to create an arms race in AI spend. What I mean by that is if you see a lot of organizations start issuing debt, then there is a much quicker timeline that we will need to see actual return on investment from the companies that are making these deals. It's not necessarily that AI is or isn't going to change how we function as a society and as a world, but as it pertains to markets, it's how quickly can we meet those expectations that the market has. So that's one of the big key themes that I'm looking at right now is, our expectations of what AI can do matching the reality of what we can see in the next 2, 3, 4 years. So just something to leave you with, and wanted to at least allow people the opportunity to ask questions. Doesn't look like we have any immediate questions at this time. So I will just review with everybody. We recorded the session today. We will be sending it out to everybody that was here and signed up. If there's anybody that you feel like will benefit from viewing this presentation today as well, please don't hesitate to send it out. We're just trying to help as many people as possible make better, more informed financial decisions. I'm also here to answer any questions. So if there's something more individual to you and your situation that you would like to get some questions answered for, please reach out to me directly. You'll have my contact information if you don't already in the email that I send later today. So I want to thank everybody for their time. Thank you for hopping on and listening to me nerd out about the markets and how volatility impacts everybody and how to be thinking about your asset allocation. I think this is such a key theme to understand and make sure that you're comfortable with. And I think it'll help paint a picture of what's going on a day-to-day basis and how to be successful as an investor long-term. So thank you, everybody. I really appreciate you joining the 27T Charted series today, and I look forward to talking with you soon.